Hello and welcome to the valuation panel. I think you've heard the introduction. There's been a lot of conversation about valuations all throughout today. And we're lucky to have a very esteemed panel of well-known willing buyers and willing sellers. So I'm going to just turn it over to them to make some quick introductions and then we can dive into the topics.
Hi, my name is Sudhir Warrior. I am a partner with Multiples Private Equity. We are a late-stage growth and control private equity fund, manage about $1 billion across 2 funds.
Hi, I'm Avnish Bajaj from Matrix Partners India, early stage VC, typical investments between 1 to 10 million and 800 million under management.
Good afternoon. My name is Shashank Singh. I'm partner and head of Apex Partners in India. We're a global private equity fund, sector focused. Been in India about 11 years. 7 transactions over that period out of our main buyout fund, about 1.5 billion or so deployed. So average check size is about 250 million.
Hi, I'm Jayant Basu, Managing Partner of CX Partners, a mid-market growth and control focused fund. We have $500 million under management.
Hi, I'm Vishal Tulsian, founder and CEO of Motilal Oswal Private Equity. We manage close to $1 billion between private equity, growth capital, and real estate.
Good evening, everybody. My name is Prasad Gadkari. I head strategic investments and policy at National Investment and Infrastructure Fund. We are a fairly new entity. Some of you might not know of us. We were set up by the government of India with an anchor commitment of $3 billion. And we are, as we speak, raising third-party capital against it. We just had our first close with a bunch of investors, including ADIA, ICICI, HDFC, Kotak, and Axis. So with that, we have done the first close for our master fund. We are essentially operating across 3 strategies. The master fund is more like an infrastructure equity fund. We also have a fund of funds strategy, and we have a third pocket, which is more like a strategic fund.
Okay, well, thank you very much, gentlemen. Just for the benefit of the audience, my name is Rishi Aswani. I head portfolio valuations and secondary market advisory at Duff & Phelps. We do these services for 400 GPs worldwide and more than a dozen in India as well. So I'll jump straight to the topic for today, just because we're on the clock. We'll dive into the main question, which is, are markets expensive? I think we've all been observing what's been happening in the public markets. Public markets have corrected a little bit in 2018. I think you've heard it in these panels earlier this morning that, India's never really been a cheap market, less so for good assets. So maybe to start off the panel, let's start with, the end of the row. We'll start with maybe Sudhir to get some PE perspective and then, ask Avnish to share his perspective on the VC market on the private side. Thank you.
Yeah, so my sense is that for almost 15 to 20 years now, a lot of us in private equity, VC, etc., we have been mining the market. And many of the simple companies which are high growth with good managements, etc., where you could just put up a few $1 million, those have been discovered and probably done, at least from the private equity side, something which has matured a little bit. Those deals are probably done, and one is going to see expensive valuations for the simple growth capital transactions. But at the same time, the application of private equity has expanded. Today, the market kind of realizes that for intergenerational wealth transfer, for situations where where one large shareholder wants out, or roll-ups or startups in very capital-intensive industries like, say, logistics, financial services, etc., that private equity is able to offer a solution and has the skill sets required to do it, the experience of having done it, the access to talent who are willing to work with private equity funded firms. All of those have expanded. And today, my sense is that as private equity funds, we will have to use our capital for doing some of these stuff, and the easy deals are discovered, and those would continue to be expensive.
So I think on a VC perspective, It also depends on how you look at it. We have Ola in our portfolio, we have Quicker in our portfolio, both of which are billion-dollar plus companies in valuation. If you look at Flipkart, none of those valuations have moved over the last 3 years, and the companies have grown anywhere between 5 to 20 times. Now, clearly that also meant that they were overvalued earlier. So I would say that companies have grown into their valuations, and when I look back at my VC journey over the last 10, 12 years, this is maybe the second or third period where I find that the market is not frothy and it's more in the in a normal state. That said, if you're playing, and again I think to what Sudhir was saying, in any sector almost, if you have a good company that is executing well, it does tend to get overpriced. So in the VC world, if you're doing Series A, seed to Series A, absolutely no problem on valuations. Series B starts getting a little bit of a problem. And C, D, E tend to get more expensive, and interestingly, after that it comes back down. Because at C, D, E, people are buying into the potential, and at later stages they're buying into the performance. So that's kind of how it's played out.
Okay, well, thanks for those perspectives. So I guess that's helpful to understand. One of the questions I had when I was thinking of this panel is, should we really be surprised where markets are? So it's a bit of a wry question. Maybe we can ask this to the panelists, Shashank, Jayanta. I guess, so much capital has been, record amount of capital has been kind of invested in private investments here in India. We've all heard the broad funnel and narrow pipe, explanation by a statesman banker in India. So are we surprised where valuations are?
Maybe I can kick off. I think at our check size, Rishi, and the types of companies we invest in, either companies are public already or they are large enough to be public pretty soon. And so anything we do practically is benchmarked to the public markets. And so to that extent, given everything that's been going on in the public markets over the last 2 or 3 years, these last kind of 6 weeks or 7 weeks notwithstanding, I think that's kind of where, at least my belief is, that the pressure on valuations turns up. And yes, if you look at the LP world, all of you guys in the audience are sitting on a lot of cash. A lot of that's come into either domestic funds or global funds that have an interest in India. That's pushing up valuation, but that's pretty much a global phenomenon from what I can see.
Okay, I'll take a bit of a contrarian view. My fund invests in very similar sectors to what Shashank does. Much smaller canvas. We are in the $20 to $50 million sort of space, where we find that companies which are priced to perfection are ones which are IPO ready, therefore you're competing with IPO markets. There's no way you can get a deal at a reasonable price. What we find is a lot of companies which have sort of, family owned, going through the transition, as Sudhir mentioned, are companies which are floored currently and therefore not ready to hit the IPO markets. We can actually negotiate pricing because they see value that we can bring to the table. And therefore, what we found is that typically we get almost a 20 to 30% discount to what the public markets are at currently. And we've seen this across the board in the last 3 or 4 years, even when a lot of money was raised, and money is being raised, significant amounts of money have been raised today. We're looking at deals which are significant discount, as long as they don't sort of fit the footprint of being absolutely perfect. If they are executing perfectly, they will be perfect pricing, and that will be listed IPO sort of pricing. They've come off a bit, but even today, it's terribly expensive. So we have deals and the stuff that we're looking at in terms of pipeline, but those companies need work to get them IPO ready, or get them strategic sale ready, or get them to financial sponsor sale ready.
Okay. Prasad, I know you have a flight to catch, so I'm going to actually turn it over to you. What are you seeing on the infra side? The market's expensive?
So I think, clearly nobody can deny that the prices have kept on going up, and it is expensive at one level. But I think overall, from a macro infra perspective, at one level, I think for us, we think it's heartening to see that there is activity which is once again starting in infrastructure after a lull of a few years. So I see this in a little more positive light. And because of several things which the government has done in terms of their reforms, in terms of the newer instruments like infrastructure investment trusts, there are some new ways they are auctioning assets. There is some kind of a market segmentation which is happening, and people are trying to, I think, focusing on things which they can do best. People who want long-term high, yields, steady yields, sovereign wealths, pension funds are tending towards those assets, which is still easier to do, whether it's toll roads, whether it's renewable energy assets, where at times the discounting rates are going tad too low. But at the same time, I think there are certain sectors, whether it's ports, whether it's thermal, I think it's not purely, I would say, in the domain of a financial investor. You need some kind of a strategic angle to play, and that's where you can better price those risks and therefore try and get some better deals. Just to give you an example, when we are looking at toll roads, we are looking at assets much like anybody else, and so there, I guess it may be competitive at one level. But when we were trying to think of our ports and logistics strategy, we've adopted a slightly different way. We've created a joint venture with Dubai Ports to create potentially the largest ports and logistics company in this part of the world. And once that kind of an entity is bidding for assets or looking at assets, then the play is very different. So I think each one is tailoring its strategies in a particular manner. One would definitely hope that discounting rates lower is okay, but people should keep in mind long-term sustainable returns is what I would think about it.
Okay. And maybe I'll just stick with you just for one more question. So are you seeing all the competition from the larger funds and the pension funds on the infra side as a positive in terms of where pricing is ticking up?
So I will diverge the question from pricing, but in terms of, I think, the participation of various investors like pensions or sovereigns, I think definitely it's positive, because the needs for infrastructure, whether whatever $1 trillion we keep saying, is humongous. So we need all of that money and much more. So I think it's really great that everybody is participating. And the way, at least from an NIF perspective, we are looking at it, it's it's a slightly different way we are playing this game. So there will be some deals, as I mentioned, we may be competing, but surely there will be so many other things in which I think we are likely to collaborate and work together. And there will be a third category of deals, which is where I alluded to our strategic fund, which probably none of these people will be directly able to participate because they are in a different risk-return spectrum. And that's where perhaps NIFs might take lead to create those assets and then pass on the baton to somebody else at a later stage. So I think there's definitely scope. Overall, I think we are happy that we have more participants in the sector.
Okay. Thanks. I'm going to come back on the collaboration and maybe competition point a little later across the panel. But maybe, Vishal, I could ask you a question. One of the things in the preface to this panel was, we're looking at this growth going forward. And while there are some provocative words in the panel description, what I want to ask you is, how much of that growth do you think is actually being priced in? How do you feel about it in terms of being justified? I know Motilal Oswal Private Equity has had, some great exits in the past few years, and you've also raised a fund. So, how are you thinking of this? How are you explaining this growth to, let's say, promoters or investors as well?
What we have realized, particularly on the private equity side, you will never get an arbitrage opportunity. You will never get anything which is cheap, because you're going to negotiate directly with the guy who's selling it, and he knows the value of his company. Unlike, on the public side, where you might get an opportunity when the markets are really down. So here, you're not going to find stuff that is really cheap. Finally, at the end of the day, your growth assumptions on the company that you're investing in has to go right. Over the last 8-9 years, what we've realized, companies that we thought at the time of investing, we've paid a little more than the fair value, and where the growth assumptions, came out right, we made more money than companies where we thought we got very cheap, but the growth assumptions or the growth really didn't pan out the way we had expected at the time of making the investment. So I think the key part is, how much of your growth assumptions they go right as far as investing is concerned. I think secondly, what we've also realized that India is not a market where you could see a turnaround, particularly the kind of investing that we are doing, very similar to what Jayanta said, 20 to $30 million kind of growth investing. Your holding period, when we were looking at investing from our first fund, that was in 2007, 8, 9, our holding period assumption was 4 to 5 years. Probably you need to look at, 7 to 9 years kind of a holding period for the growth to really pan out. And most of the cases where we were able to hold it for that long period of time, we have seen and we think we will continue to see a significant upside on the investments that we are doing.
Okay, thank you. Actually, that brings me to an important point. So earlier today also there was a discussion about value creation and how important that growth story is, because we're not an LBO market, we're really a growth investing market. Maybe I can ask the question back to Avnish. Avnish, how important, I mean, let's start with the VC perspective, from with you, how important do you think, the question is whether the market is overheated or not in terms of buying at the right price versus actually the value creation that you're going to create in 5 to 7 years?
So in our business, there's a power law. You make all your money in that 1 or 2 investments that really take off. Funny story is it's funny now. It wasn't at the time, but Ola, we modeled it. This is 2012 when we were investing. It was a taxi company. We didn't know about Uber. And we valued the exit at 125 million. Today the company is worth 5 billion. And we refused to move from the 20 million valuation. And finally we made the investment. Now, at the same time, see, when you are entering and if you are absolutely sure it's going to be $1 billion company, price doesn't matter. But the point is, if you're so sure, then everybody else will be, and that definitely won't be the $1 billion company. So you have to be disciplined. But in our business, it's a bit harder because, again, the outcomes are very, very diverse. It's not, in most cases, it's not linear. So the way we try to stay disciplined is we say, if our assumptions were to pan out, then with this capital, how far can this company get? What kind of business can it build? And what would that be worth in a normal cycle? And then we back into what we think we can pay. But I would say, again, if you're getting into, there are people who invested in Facebook at 10 billion of price, and today the company is worth 700 billion, and at that time it seemed like an absolutely crazy deal. The next highest offer on Facebook was 7 billion, and this was Yuri Milner of DST. He came and paid 10 billion. So, but I would say that's not an easier one, but at least you're investing behind traction and you're taking a call. At the stage that we operate, we don't even, sometimes it's literally, there's no data. And so I think you basically, you do have to be disciplined because that's your margin of safety ultimately.
Sure, go ahead, Shashank.
Rishi, I'd like to jump in on something Vishal said. And I understand the philosophy of, you pay up for a company with momentum, right? And a good multiple. But just to give, I guess, a little bit of an alternative perspective, of the 7 deals that I mentioned that we've done in India, and we all know that India is an expensive market, it's been expensive for a very long time, we paid single-digit EBITDA multiples on 5 of them, or the equivalent. A couple of these are financial services businesses. Of the 2 that we paid high multiples on, one of them was in the hospital sector, and we paid 17 times going in thinking it was crazy, but we exited at 20 times. Now, maybe that was luck, probably was luck. And the other one for which we paid up, I think the multiple has contracted on that business, and it's a drag. So at least our philosophy is there is so much about life you can't control. Right now, public markets are good, currency is good, everyone's, there's been a few nice exits, everyone's feeling happy. If I rewind the clock to 5 years ago, currency was against us, exit markets were shut, there was an indirect tax law that had come in, all sorts of wonderful things were happening. And those are variables we can't control, right? You can't control regulation, you can't control currency, you can't control exit markets. So we very strongly believe in two points. The first is the the one variable you do have control over is your entry multiple. Now the flips, so remain disciplined, to the point Avnish also made. So the flip side of that is you've then got to have the appetite to say, well, for large periods of time, I won't do anything, right? I'll wait for my moment. Easier to do in a global fund like ours, and tougher to do with a dedicated pool of capital for India. So that's one. Two is, beauty is in the eye of the beholder. And by that I mean, you could be paying what on the face of it seems like a high multiple to a promoter, say you're buying a business from. But if you've got quite a lot of experience in that sector, for example, we've done a bunch of deals in IT, where you're buying down your multiple very quickly. Within the first 6 or 12 months, you may have paid 12, 14, 15 times EBITDA to somebody, but post synergies, etc., you're looking at single-digit multiples. I think that's the other way to kind of skin the valuation game. So, we are, for better or for worse, we are value buyers. We'll wait for the opportunity. It's tough to do deals in this kind of market. But, the bear market will also arrive, and that's the time to basically to go all in. At least that's our belief.
That's great. Thanks, Shashank. And I know Prasad has to leave, but you actually provided the next lead into the next question that I had, which is on competition and competition driving up valuations in the private space. And I'm glad you mentioned about the discipline. So I wanted to ask maybe the other panelists, because you've answered this in a way. I wanted to ask the other panelists if, how they see their pace of deployments. Are you tending to walk away more from certain deals? Feel free to take it as you like.
Okay, let me just jump in. In terms of competition, one is competition. The second is the banker market. Okay, India is an overbank market, whether we like it or not. I mean, as a result of which every deal or every other deal, I mean, everybody talks about proprietary, but let's talk about the non-proprietary transactions, which are banker-led. I think the banker itself creates a lot of expectations amongst the promoter community, which creates a lot of dissonance as the deal comes to the market. I think that's one which we need to sort of address, and that creates benchmarks which are probably not that valid. And the second is, of course, in terms of competition, I think there's different sets of competition across different amounts that people play in. We've seen there are gaps, for example, at the larger end, there aren't that many players. So they'll be relatively more disciplined. There will be, within particular sectors, there'll be a certain amount of discipline. Certain sectors are just really hot. I mean, it is the way it is. It is a very sexy sector. Healthcare becomes sexy one day. Financial services, NBFCs become extremely sexy the other day, and as a result of which, valuations get driven up. So you just have to be, as Shashank said, or as Avnish said, you just have to be very, very disciplined getting in. Because the chances are, if you get caught on the wrong side, you could be very badly burnt, if the multiples sort of contract. At the same time, if you get in at a reasonable multiple, the chances are, if you can actually do some work on that portfolio company, it'll lead to a re-rating of the multiple when you exit. And you can actually work on that.
Understood. That's great. Avnish, I'm going to come back to you on the VC side. Would you like to take this question on competition? I mean, we hear so much of SoftBank. I don't know how you think of them, whether they're a competitor or a buyer, but love to get your perspective.
SoftBank invests our entire AUM in one deal or a multiple of that. So they are not competition for us. And when they invest in our companies, we really like them. When they invest in our companies' competitors, we don't like them. But I think underlying that is a little bit of a worrisome trend, which is that capital for later stage companies is becoming free almost, given the pricing that is, both the price that is being paid as well as the amount that is being given. And that is not a recipe for good behavior or good returns. Who knows how long that music will last, but there's a lot of other investors who are also looking to raise a very large funds as a result. So that's worrisome. At the stage where we play, there are 4 or 5 VCs, frankly, in India that have kind of gotten their reputations a little bit more established or have been around for a while. So competition is not what I worry about the most. Getting into business with the best founders is what I get excited by the most, and what I do worry about the most, missing that founder, right? And what has started happening is, because there's been enough vintage with some of the VCs, we are working a lot more with each other. So there have been multiple situations where, but generally only if the founder wants it that way. So the founder will say, I like one more VC as much as you, which we don't like to hear, but if he says, or he or she wants to do that, we'll syndicate. So we work with Accel, Sequoia, SEF, all these guys all the time. So there is, like I mentioned before, at Series B, Series C, we have lost a number of deals due to overbidding and overpricing. And it's seldom by the India VCs. It's usually by global strategics. And it's not SoftBank because, I mean, it's a $10, $15 million. It's usually corporate global VCs.
See, right now, I think at this particular point in time, the biggest competition for people on the growth capital side is largely coming from equity capital markets. So many of the companies are actually contemplating to go for an IPO, even if they are at a valuation range of, let's say, 1,800 to 1,800 crores and above, then taking a private equity. I think that's a big competition more than anything else at this particular point in time.
That's helpful to understand. I think I'd heard that in the pre-huddle when we were talking about competition as the public markets being competition for actually private money. So I guess that's interesting. So I guess, I hear a bit about, co-investing. I hear a bit about collaboration also from Prasad. So, it's really about choosing the right company, the right founder, and, not bidding up the price, really getting it at what you think is the right value. I think we're doing well on time, so I'm just going to turn it over to some other questions that I had for the panel, for each panelist. Maybe, Jayanta, we can ask you, is this phenomenon so-called of a scarcity premium? And we were talking about, your ticket prices being in the $20 to $30 million, maybe let's say the company is a mid-market company as well. So there exists some scarcity premium in certain sectors here, believed to be in, let's say, healthcare companies.
Okay,
Would you like to address that?
As I said earlier, I think there are sectors which become sexy at different points in time. We've had healthcare, and within healthcare, sometimes pharmaceuticals, sometimes healthcare services. They've all sort of had their place in the sun. We've had clearly in financial services, another sector which we saw a big boom. Microfinance, then affordable housing. There's a flavor of the day, and those really get priced up. So you have to be very, very careful. Luckily, we have a multi-sector strategy. So we will sort of, switch from one to the other depending on where the multiples are on those particular sectors. So healthcare service expensive, mid-market pharma may have been beaten down because of all the FDA crackdown. So could be opportunities there. Mid-market IT, because of change in business models, clearly have seen a significant contraction in, multiples. Maybe that's something to do there. So we would sort of switch, gear in terms of the sectors that we look at to sort of address that issue. We would try not to get caught out in that bidding war and land up at a multiple which is probably not sustainable. And, things change in India. Governments change, policies change. You've got elections coming up. Who knows what's going to happen?
Sure. So, Vishal, maybe I'll ask the question to you because I think your fund invests in industrials. What are you seeing on the industrial side in the private market in terms of valuation trends?
So clearly, at this particular point in time, flavor of the market is largely, consumer financial services, healthcare. Industrial as a sector has not found a lot of favor with investors per se. And there again, while we are also a sector agnostic fund, it's not that we've done a lot of industrials. For example, over the last 11 years, there's only one auto ancillary company that we did, which was Minda Industries in Fund 1. Though the outcome has been phenomenal, but we've not come across another auto ancillary company that we thought we could back or which would really require funds at this point in time. So I think opportunities on the industrials are going to be far and few. Companies that we really like and we would really like to back, they don't need money at this particular point in time. And companies which would really need capital at this point in time is something that we would like to avoid. So I think it's a weird situation. But I think as a fund, we've realized that it's a sector where 20 to 25% of our fund we would like to invest in. We've had a good experience with this sector per se over the last 10 years, but we are not finding enough transactions at this particular point in time. But I'm sure, with the revival in capex cycle, which has been eluding us for so many years now, but at some stage we will find some opportunities.
Okay, thanks. Shashank, would you like to take a similar question, just with the reference to the 4 sectors that APAC primarily looks at?
So we don't do industrials. That's not one of the 4. But for better or for worse, all of the 4 sectors fall into the category of, loved by the market: financial services, consumer, healthcare, and technology. I think the key really is to as I talked earlier, is to find, what is your angle on the deal, right? In terms of our process, when we even discuss it within the team here in India or take it to our committee, if we ask ourselves the question, why is Apex the right owner of this asset? And if we can't articulate clearly why Apex is a better owner than anybody else or the public markets, then we pass on it. Because we will inevitably lose, right? Whether it's quote unquote proprietary or an auction, people will do a market check and so on. And the answer to that question, why are we the right owner, has got to be either I have a differentiated view of this industry. So for example, when we invested in Cholamandalam in 2014, it was right at the bottom of the CV cycle. The industry was suffering from the mining bans and all of that, and there'd been a 10-quarter down cycle in commercial vehicles, unprecedented. Most CV down cycles are between 4 and 6 quarters over the last 40 years. This had lasted 10 quarters. And so our view was, when this came back, which it would, there would be a catch-up both in multiples and in earnings growth that would give us a return very, very quickly, which indeed it did in 2.5 years. So there our view was, we have a differentiated view of the asset. Or we have a differentiated value creation plan. So be it iGate, where the value creation came through consolidation, or Global Logic, where it came from a complete overhaul of the management team and the focus of the business, its customer set, et cetera, et cetera. We always approach it from that perspective.
Thanks. So it's helpful to get different perspectives on the investing across different industries. Maybe getting back to the VC space, Avnish, you mentioned earlier that you thought we were in a normal period. And so could you address to us, how long you see this normal period? I guess you mentioned, there's been global venture capital arms of global firms kind of investing in India, besides the SoftBank, or maybe you can address it with or without SoftBank in the question.
No, so a lot of this has been, again, at the later stages. I would say Tencent has become very active, Alibaba is active, Google is active, SoftBank is active. If you look at SoftBank's strategy globally versus India, actually a lot of these other guys are investing a lot more than SoftBank. SoftBank has taken 1 or 2, key bets, or a few key bets, but it's not. So a lot of these other investors also investing a lot. So I would say but it is not in a bubble. They invest, a lot of these deals are getting negotiated for a very long period of time. They're not willing to pay up, which is good. And like I said, for us, if you are, I was just telling, we were with our team at a quarterly offsite yesterday, and my advice to everybody was, this is the time, like Shashank was saying, you have to pick the times to go all in. And this is that time. But if we have figured it out, others have also figured it out. So that's one of those times. When it'll change, I have no idea. I think there are rumors about Flipkart, which all of you would have read. If some of those things are actually true, then we are probably getting into a heated environment again. Much as I think very highly of the company, but it's a pricing point.
Okay. So maybe, Sudhir, I'll come back to you. Let's get back to the same question that we started the panel with. Multiples as investors from Europe, the US, and in India. What are you hearing from those investors? Do they also think the Indian market is on the overheated side? I heard the word frothy earlier on the panel at some point.
So I guess from international investors, very often you hear this story that India is expensive. And that's I think irrespective of whether it is 2018 or 2012 or 2007, because when you look at Indian multiples compared to other emerging markets, we have always been on the higher side. But that said, there is still a lot of interest in investing into India. And why international investors? I think the question should first be asked of us. Do we find it overheated and not the right time to invest? I still think, like many of the points that is made here, that there is a huge competition from capital markets, particularly if you're trying to do a minority transaction of saying that I want to put 10, 15, 20% into a company, you're going to face competition from the capital markets. But there are also situations which are otherwise, and many of those are kind of playing out. Today, for example, you would have a situation of a TPG having invested in Vishal Retail, and there is an outcome that is seen there. You have situations of platforms that have been invested in. Sector specific, I think that Avnish mentioned the point that if you're getting early enough, the multiples don't really matter because you're kind of saying, do I have conviction in the growth story? Certain other sectors also, because of the growth opportunity that is there, have lent itself to still making money despite the higher valuation. And all of the sectors that Apax's interest sectors, despite the fact that they are darlings in the market, they have high valuations, money is still made because they continue to grow in. The industry itself has matured. For example, in 2007-8, I could state several instances where private equity had valued auto ancillary companies at 15 times EBITDA, or EPC companies at 15 times EBITDA, and so on and so forth. And today, for example, there is so much of learning in the industry of what sectors are amenable to higher multiples, where you can, so choice of sectors, stage of companies, there are multiple learnings that private equity investors have. And I guess, again, to take the point that Shashank made, when you sit with 20, 30% in a company, you can also be destroyers of value, in the sense that if you just pay up the highest value and win a deal without conviction, without having built the relationship with the entrepreneurs, in the first sign of downturn, the way you behave is different. So what does it mean to be in partnership is also something that I think PEs have learned. And therefore, this particular question of what is my angle into the deal? Why do I believe that even if I pay up, where do I compete? I don't compete in every deal. There are certain deals where I would compete in because I feel that I am the rightful owner, or owning this asset would do better for me. So my sense is, internally, I think a lot of us still have confidence to invest into the country, and that confidence is what your investors, whether in US or Europe, will hear, and they will evaluate by.
Thanks for that. So I think we're hearing some common themes here, picking the right company, the right promoter, spotting the right sub-trend, having an angle on the investment. Maybe we have very limited time. We have a minute and a half, and I'll open it up to questions. Maybe just one last thing, crystal ball gazing, we're talking about maybe the market getting overheated. I mean, we understand that the next few months may be a reliable exit environment. So being an overheated market may not be entirely negative because we obviously it's a good seller's environment. Would anybody like to comment on any caution that should be thought of for the future?
Yeah, it was quite interesting till a person by the name of Nirav Modi got himself into the ring. But we think, honestly, with what has transpired over the last week, 10 days, at least for the next 3-4 months, markets is going to be a bit shaky in terms of even the IPO market.
I actually think for the rest of the year, the IPO market is going to be volatile. At the same time, I think if you've got a good company, which is, leader in its niche, is very presentable, I think the IPO market is deep enough to absorb it. But if it's just one of the many, you'd probably find it much tougher to hit the IPO markets over the next 4 months, till the next elections, actually. So.
Understood. Shashank, Avnish, anything else you'd like to add?
No, look, in the VC world, we live for and with boom and bust cycles. We actually genuinely like it that way because that's the creative, that's how creative disruption happens. And the VC world is about innovation. So I'm hoping that we'll make all the right investments and next year will be a bubble and we can sell in them.
Thank you for your time. This has been great. Thanks, everybody. Please put together a round of applause.